Thanks, Waimon, and thank you everybody for the opportunity to discuss something that's very dear to my heart, which is sort of the sort of BEPS 2.0 or sort of the inclusive framework sort of two-pillar approach. That is the latest tax developments that we're looking at trying to harmonize and introduce a global minimum tax rate. So I guess where are we in the process? What's happened? Why are we here? What is going on? So just to level set for everybody, Pillar 1 is a allocation to markets for the largest and most profitable businesses. It is designed so that 25% of the profit above a 10% margin gets reallocated. And there's a removal of digital services taxes. So that's Pillar 1. It's not it will apply to a small number of global groups, and the impact we think for captives will be relatively minimal. Pillar 2, however, is likely to be more significant. It's a global minimum tax of at least 15%. Well, that's the intention. It applies on a country by country basis. And there's also a secondary rule or sort of another rule to ensure that certain income, there's a subject to tax of at least 9%. There's a political agreement that is running from the G7, G20, and the OECD inclusive framework. So the G7, that's the 7 largest economies. The G20, that's the 20 largest. The OECD inclusive framework, that's statement that's been signed up by 136 countries. So G7, G20, Switzerland, Bermuda, Channel Islands, Singapore, Hong Kong, Malaysia, so a large number of jurisdictions. 4 haven't signed up, Kenya, Nigeria, Sri Lanka, Pakistan, for different reasons. Some of those reasons are public, some aren't. This has been sort of a significant acceleration of effort in respect to this. So if you'd asked me a year ago, where are we in this process and when do you think the rules will come in? I said, look, if the rules might not come in till 2025, 2026 at the earliest. Now we're talking about the rules coming in 2023. What's caused that increase in focus, that sort of momentum to pick up, has very much been actually some domestic changes in the US. So the change in president, the election of the Democrats has changed the political landscape in the US when it comes to tax. They are looking at certain tax reforms internally in the US and domestic tax reforms. And one of them is to change, and one of the things they've been looking at doing is changing their equivalent rule, better known as the GILTI rules, and increasing the rate on GILTI and moving it from potentially from a worldwide basis to a jurisdictional, so country by country basis. In response to that, the sort of Biden administration realized that they would not get the support they needed, in particular from certain US businesses, if they did not sort of also encourage the global community to also introduce this equivalent, which is Pillar 2. So that sort of forced and generated some significant momentum behind this, and has led to an engagement on Pillar 1 and an acceptance of Pillar 1 from the US in the context of removing digital services taxes. So if other jurisdictions remove digital services taxes. So I said that sort of Pillar 1 wasn't sort of expected to apply and only apply to a limited number. I think sort of just one point to bear in mind is that's what we're talking about in Amount A. So you'll hear something called Amount A, and that's the share of the residual profit. There is a formulaic approach. It will likely apply to around 100 companies, maybe a few more, maybe a few less, but it's not intended to apply broadly. Amount B within Pillar 1 does apply more broadly, and that's a fixed baseline return for marketing and distribution functions. And one of the other things that is key for Pillar 1 is to deal with Amount A and to deal with potential tax disputes, is to introduce a dispute prevention and resolution mechanism. So that is Pillar 1 in a nutshell. Pillar 2. So Pillar 2, that's where we may see a significant impact for captives. There is a priority rule. So the initial rule is around a subject to tax rule. It means that sort of there should be source country taxation of specific types of intergroup payments. The threshold is that the idea would be that there's at least that payment gives rise to a 9% rate in the jurisdiction to which that's paid. So what's potentially within the scope of that? Potentially we might see commissions, we might see premiums. So there is a risk that if the country to which these payments are made is a low tax jurisdiction, that potentially subject to tax rule might apply in the context of captives. So we may see the STTR rule apply to certain captives and certain payments to captives. The main rule, and what is really why people are referring this to the global minimum tax, is the income inclusion rule, so the IIR. So what is the IIR? So the IIR really is a rule which seeks to ensure that multinational groups, and when we say large, we're talking about groups with revenues of more than 750 million, that they pay tax of at least 15%. And that is in each country in which they operate. So if, for example, we had a group with a captive in Labuan, we would expect the tax to be paid in Malaysia to be at least 15%. So if you had no other operations in Malaysia and you were taking advantage of the reduced rate of tax in Labuan because you had sufficient substance in Labuan, that could potentially be an issue. And you won't potentially have an additional top-up tax to get you to that 15%. How do we calculate what is that sort of minimum tax? What do we calculate, and what do we include within the numerator, and what do we include within the denominator to get to that 15%? So we're waiting for some rules and detailed rules to come out in respect to that. The rules were actually due to come out on the 30th. So there was a comment from the OECD that they, in their sort of October statement, that the rules would be developed by the end of November. There wasn't a publication on the 30th November, and we are expecting a publication at the end of this week, so potentially sort of today or tomorrow. And we're expecting sort of a significant sort of level of detail with regards to that, although there may be sort of further refinement over the next year. What do we expect? So we expect that effectively the numerator will be the income tax you pay in your jurisdiction. So and you would add up that across all of the operations in your particular jurisdiction. So in Malaysia, for example, in that one, or if you have a captive in Singapore, etc. And then you would look at what is your profit before tax and make certain adjustments to it. Now, one of the questions is, can you use the group GAAP or could you use local GAAP for your profit before tax? So if we think about that, we may be in a situation where our group is a US GAAP filer, or it could be a Canadian GAAP, or it could be IFRS. It could be sort of whatever GAAP it is, and then we have to look at the local jurisdiction and what is the relevant GAAP, and is there a difference? We're still waiting. The original rules suggested that you would have to calculate the denominator using the parent, and so jurisdictions GAAP. So if you were an IFRS filer, IFRS. If you were US GAAP, US GAAP, etc. But there may be a relaxation of that to use the local GAAP to the extent they're not significant differences. How that applies in the context of insurance and in the context of IFRS 17, where IFRS 17 is significantly different from the majority of other GAAPs dealing with insurance, we'll wait to see. But that is sort of one point to bear in mind. So if that sort of rule comes in, the other thing that we also need to consider is any timing differences. And the original rules as they were drafted, it wasn't clear, and the mechanism that dealt with sort of deferred tax. So what I mean by that is where there's a difference between the recognition of income for tax purposes and recognition of income for accounting. So in an insurance context, where sort of policyholder liabilities, claims reserves, etc., there would be a difference between sort of accounting and tax and the timing of deductions for them. The original rules, the way those worked was potentially may have been an issue for insurers, and therefore they're also captives. And we're expecting and we're hoping still, and the industry's pretty sort of done a really good job of pushing back on this to get some form of relief for deferred tax. But again, until we see the rules, we won't know for certain, and that should sort of reduce some of the complications. But I think that sort of suffice to say, if we have a captive that is earning, let's say, profits of $1 million and is for accounting purposes, and for example, is paying tax at sort of a 5% rate or a 10% rate or a 3% rate under local rule, which it might be doing in certain jurisdictions, then there will be a top up. And that top up will take you to at about sort of 15%. So there will be an additional tax charge for the captive. So I think one of the points here is where groups have been looking and seeing captives as a way to help manage their overall effective tax rate, and where they've been looking at certain savings in relation to tax as a result of having a captive, those might be eroded. Now, the point here to mention is this is a minimum level of tax in each country in which you operate. So if we're thinking about Asian groups operating in Asian jurisdictions and having a sort of businesses in Malaysia and having a captive in Labuan, or having businesses in Singapore and having a captive in Singapore, etc., it's very clear that actually you can blend the rate. So in a jurisdiction where there's a higher rate of tax for mainstream profits and mainstream companies, you can then still effectively reduce your jurisdictional rate to within that sort of and be above that 15%, depending on the size of your other businesses and the amount of tax you pay there. I guess one of the things to consider is what are countries doing about this, and what might sort of certain jurisdictions do. So one of the things that has been interesting, and we've had sort of some conversations with, is a number of jurisdictions in Asia have looked at this and said, well, look, we want to encourage investment into our jurisdiction through our fiscal policy, so through our tax policy. By doing this, we've changed our rules in respect of certain requirements over the last sort of 5+ years as a result of sort of what's known as BEPS 1.0. So the original rules relating to the profit shifting and ensuring there's sufficient substance, etc. We can see sort of the substance requirements that have been brought into captive regimes all throughout Asia. So we've now got all of these substance requirements, and now you're looking at introducing this global minimum tax. So what do we want to do in response to this? We want to protect our tax base. So what we want to do is, if you're going to put in place a global minimum tax, we in turn want to be able to collect tax from companies which operate in our jurisdiction, have substance in our jurisdiction, and which you're saying they need to top up their taxes. So what is the approach to do that? The approach to do that is to introduce a domestic minimum tax. So that mirrors what is known as the IIR rule. So the idea behind this would be that the likes of Hong Kong or Singapore or other jurisdictions where they might be at risk of having a large number of groups fall within this income inclusion rule, is they would introduce a domestic minimum tax rule. The domestic minimum tax rule would mirror the income inclusion rule. And the OECD Inclusive Framework has said that they are likely to introduce some model rules that set this out, so how the domestic tax minimum tax might work. And then you sort of work out what's your mainstream tax and in your jurisdiction, and you do your jurisdictional blending and all your calculations, and you work out, well, actually my taxes are only 12.5%. And you compare that to and say, well, actually now that additional 2.5% of tax, I'm not, instead of my UK parent or my French parent or my German parent or any other sort of parent, what I'm collecting that, Singapore will collect that. And so a company within Singapore would have to sort of pay that over to the Singapore government, or similarly to Hong Kong, if we're talking about Hong Kong, etc. So no jurisdiction in sort of Asia has come out and said that they will introduce a domestic minimum tax publicly, but a number of them have sort of indicated that that is something that they're considering. I realize I haven't talked about sort of the backstop rule, which is on here. So that backstop rule, that the undertax payments rule, that's really intended where people don't introduce the global minimum tax, so they don't introduce the income inclusion rule. Which jurisdictions might not introduce an income inclusion rule? Well, they may be jurisdictions where they are not so they are subject to a lower rate of tax, and they've just taken the decision they don't want to introduce a income inclusion rule, and they don't want to introduce the domestic minimum tax rule. So there may be some to which this applies. It's not intended that the UTPR will apply in many cases, because the thought would be that most jurisdictions would want to introduce the income inclusion rule and these rules in order to collect the tax and not allow somebody else to collect the tax. For example, in the European Union and the European Commission has been very clear that they want to try and introduce a European directive to legislate for this, so that there's consistent rules across the whole of the EU. And would apply to any EU parented group. So, I mean, that's the sort of Pillar 2 rules in a nutshell. 15% minimum tax rate, likely to be a pickup and likely to be an impact for captives, where captives avail themselves of some form of exemption and lower rate of tax. But if you have operations in a jurisdiction in which the captive operates and they're subject to a tax rate of above 15%, then the rule may not kick in, because you may have sufficient profits that are taxed at a high enough rate. I know I mentioned IFRS 17 earlier. I think sort of just be remiss of me when we're talking about captives, we're talking about tax developments and sort of international tax developments, not to mention IFRS 17. I think sort of, again, one of the things to bear in mind is in Asia, clearly sort of we sort of Asia adopts, and a lot of jurisdictions in Asia have adopted IFRS as the basis of our local accounting standards. As a result of that, there is a requirement to sort of adopt IFRS 17 in a captive context. And then in certain jurisdictions, tax does follow the financial statements, and so if tax follows financial statements, there may need to be changes to tax rules to accommodate for the IFRS 17 changes. No jurisdiction has set out what those tax changes might be. Likely to sort of see Singapore introduce, and sort of there's been a long running consultation in Singapore, so Singapore may be the first. expect sort of Malaysia to introduce something towards sort of next year in relation to that, and other jurisdictions to follow. So I guess that's a whistle-stop tour of some of the developments. So I think I've probably run out of time to take any questions, but I think my contact details are on the next slide, and these are going to be sort of circulated. So if anybody's got queries they want to follow up with, please feel free to send them through. Thank you.